how's it going? ExxonMobil just released their earnings report for the third quarter of 2020. I have been anticipating this for, I want to go over things with you. I just read it. It's real early in the morning, 8:30 to be exact. The market seems to not love what they said, but reacting not in a positive or negative manner, but at 9:30 we will see what actually happens. So let's get into the report real quick. Today they announced about a loss of 680 million, or 15 cents per share, assuming dilution. Just to be clear, again, this is negative 15 cents per share. Expenditures was 4.1 billion, bringing the year-to-date to spending of 16 billion, more than 6 billion lower than the prior year. So again, they spent a little bit less than last year. Around this time, third quarter results improved by 40 million from the second quarter, primarily driven by early stages of demand recovery, excluding identified items or something. So, basically, they made about 400, or didn't lose as much, in about 400 million since last quarter because of demand stuff. They are on track to reduction targets for capital expenditure. They are on track to exceed reduction targets for 2020 capital and cash expenses, further reductions anticipated in 2021. So as we will see, their estimates of how much they were going to spend and lose they overshot it a little bit, so they cut back on their anticipations going into 2021. So this is their earnings summary. I like to look at, the 9 months, just gives a little bit longer time frame. But they, as opposed to, or this October 30th, as opposed to last September, they lost 10 billion. So, million, so 10 billion relatively to 2019 around this time, the 9 months preceding. That's a lot of money. Kind of sad, but it is what it is. The company's doing what they're doing to, come back. The earnings per share relative to this time, 2.3 to negative 0.55. We can look at quarter to quarter, at the third quarter as of 2019, there's relatively, again, it's not happy numbers. They're looking pretty dull, not earning any money. In fact, losing a lot of money. Here they talk about the oil demand. I want to read you what Darren Woods said. We remain confident in our long-term strategy and fundamentals of our business. We are taking the necessary action to preserve value while protecting the balance sheet and dividend, said Darren Woods. We are on pace to achieve our 2020 cost reduction targets and are progressing additional savings next year as we manage through this unprecedented down cycle. So he seems to be pretty confident in his understanding of the business and how they're going to manage this crisis. And I don't want to just take his word for it all the time. However, I just hope for the best, I just hope it actually happens. So, we'll see. The 2021 capital program, they still have to review it, just keep that in mind. For the fourth quarter, is expected to be in a range of 16 to 19 billion, reduction from the 2020 target of 23 billion announced in April. So they cut back the amount of spending they thought they were going to spend this or next quarter. So they cut it back 16 to 19 billion. Their third quarter business highlights. Their upstream thing, crude oil, improved significantly as market prices increased. The second quarter of 2020, oil prices got pretty smacked, and natural gas, real estate, river prices basically declined too. Their downstream, they mentioned, supply chain optimization, higher product sales due to increased demand and higher margins. Third quarter saw the best reliability and process performance in the last 10 years. I'm not exactly sure what this means, because how can right now be the best reliability and process performance in 10 years? I don't, while average refinery utilization is increased, I just don't understand this part. They don't mention it anywhere else, so keep that in mind. The chemical aspect of the business. Sales were higher than second quarter, benefiting from resilient packing demand and recovering automotive and construction markets. Chemical margins were negatively impacted by higher feed costs. So let's go to strengthening the portfolio. They announced announced that they funded this development in offshore I don't know. This is probably South America or, yeah, most likely South America. By 2024, we'll have the capacity to produce a lot of oil per day. But that's again in 2024. That's 4 years from now, 3 years from now. So I'm not sure if this is a good decision. Again, they're strengthening the portfolio, but again, they just cut like workers, and they're keeping their dividend and stuff. It's just, I guess I can see why they did that. Workers can be inefficient, they can be whatever, But again, if you're, like, I guess they're funding it, so exactly what this part of the business is in strengthening the portfolio, I'd have to look a little bit further. Maybe it's more like a royalty business, like we're gonna fund this and get the rewards after. To keep that in mind, the focus remains on lowering overall development costs through efficiency gains and technology applications. Again, they're cutting workers because workers are sadly not efficient some of the times, especially in, like, if they're not making money, they don't need to be doing the things, or they might need to have a lot more workers, just stuff like that. It's sad, but it's also kind of true. The corporation is assessing its full portfolio to prioritize assets with the highest potential value within its broadening range. So it kind of sounds like if they sense things are negatively impacting their portfolio in a bad way, or if they have like a bad, let's say, oil rig or something, they most likely will not sell it, but address the problem and see how they can make it better. But they definitely want to keep all their high value assets, which they have a lot of. But yeah, we'll see how they manage it. Discipline investing and cost management. I highlighted this whole thing just because it seemed pretty important to the conversation. They made significant progress during the quarter on previous announced capital and cash operating expense reductions, planned in reductions to the 2020 capital spending program from $33 billion to $23 billion. Are ahead of schedule, reflecting increased efficiencies, lower market prices, and slower project pace. An expected decrease in cash operating expense of about 15% is also ahead of schedule, capturing savings from increased efficiencies, reduced activity, and lower energy cost and volume. So they're doing a lot to really minimize the impact of, losing money. They're trying to save where they can, and it's like the weird thing too is, again, their dividend is like 10%. They could cut it, which would cause them to save about 11 to 12 billion each year, which would make them very stable of a company. But so they've been paying the dividend consecutively for like 37 years, I think, maybe, yeah, about 37, 35. And they just mentioned how they know a lot of people rely on the dividend as a form of income. So because of that reason, they are very adamant about that. Everything I read, everything I come across comes off as that. We'll talk about that more in a second because I just want to finish up the report. Then we'll talk about the dividend, the company outlook from my point of view. And yeah, just see that. So anyway, advancing innovative technologies and products. So they continue to progress on working on a carbon capture technology aimed at scaling carbon capture technologies and aimed at reducing emissions. They're working with the University of Berkeley. The discovery of a new material that could help capture more than 90% of carbon dioxide. They're obviously working on trying to reduce emissions. In my opinion, I feel like this is just here to sound nice. I would have to look at the exact studies they're doing. I'd have to look at what they're actually doing to reduce. Like just them mentioning this kind of just says, hey, yeah, we're kind of doing something to, maybe discover new material, do this, which is great. I hope they do, but I would need to know more about this specifically to like verify it. But yeah, it's kind of cool. I guess I could go to their website and see the study if it's not like classified or something. Might be a little bit though, especially if it's a brand new technology. Let's go down to, there's the volume summary. I like how they did this. So we're talking from third quarter 2019 to third quarter 2020, just comparing to where we were last year. So the total upstream down a lot. Again, prices, volume, expenses was actually, higher, so that's bad. Pretty big change in number. Downstream, same thing, big change in the number. The chemical was actually up, which is interesting. interesting is compared to last year. Higher margins, lower expenses, variable item, identified item, and again, lower margins. Our non-US was actually lower margins, more offset by lower expenses. At the end, they actually made money. We're better 3 times than last year around this time. Go down to the volume summary. So now this is the same data, except we're doing the last quarter to this quarter of 2020. So upstream, they compared to the last quarter, they're much better, like about 4 times. Lost a little money, Downstream, they doing worse. The chemical, again, they're doing pretty healthy relative to last quarter. This, if you want to look at the year to date, it's the same data, or same idea, total upstream, it's kind of the same stuff. Go down. Is there cash flow from operations and stuff? This has nothing to compare to. So the first 9 months of 2020, ExxonMobil purchased 6 million shares, about 305 million. These shares were required to offset dilution in conjunction with the company's benefits and plan programs. The corporation will plan to continue to acquire shares to offset dilution. So to me, they didn't, buy the shares because I feel like they had to. They had to buy the shares, because they didn't want too much dilution because of things they were doing with benefit plans within the program or the company. I do like to see companies are buying back shares, but I don't think they're in a position where they should. Although, if they think the stock is really cheap, then yeah, I guess it would be a good time. But, I don't know. That's just something to keep in mind. Okay, let's get down to some more stuff. Let's see. We could take a look at the first 9 months. I prefer this data because it's just a longer time and horizon. So the first 9 months of this quarter, the last 3 quarters, compared to 2019. Revenue-wise, they're not losing that much. It's just they're not making money on that revenue. Let's see. It's kind of interesting. They're paying like nothing in income tax. Just because I guess they're able to deduct so much. Let's go. Wait. Total costs and other deductions. They're able to deduct more than they actually make because if they lost money. So they pay. I don't know all the loopholes in this, but that is interesting to take note. Let's go down. See here they talk about dividends. Each quarter they pay about 3.7 billion in dividends. So each year they they'd save a lot of money. So right now they pay more than 11 billion. That's like 15 billion each year dividends. That's pretty expensive. They seem pretty adamant about it. We'll talk about that again in a second. Sorry, I keep getting sidetracked. One thing they don't have on here is their balance sheet. I don't know why they decided to not put that up. Maybe they'll show it later or something, I don't know, but as of right now, I don't see the balance sheet anywhere on here. They get into more specific stuff. Yeah, I want to show you guys net production of crude oil, natural gas, and everything else worldwide from the first 9 months of 2019. It's about the same, so they're just producing the same amount, which makes sense. Like, why would they stop producing the oil and stuff? But natural gas, worldwide, they're a little bit down. Natural gas production as well for sale. But again, they're still making the oil and stuff. It's just at such a cheaper price, and the demand is not there. Here it gets into more specifics about we gotta discuss the cash flow. This is again the first 9 months. Cash flow is down a lot, significant amount. Well, more than half it's cut. Again, their margins are destroyed, and yeah, just cash flow is in a bad place compared to 9 months ago from the previous year. This is their earnings per share from 2016 and on. We have 43 cents for the year. 1.88. You have 4.63. 2017, 4.88. 2018, 3.36. 2019. This would be the first year. So we got 14, 26, 15, 30, 40, 50. So about 66 or something. 65. Negative 65 cents a share. So it would probably be like $1. Being conservative, about a $1 loss, maybe. Just averaging these numbers and adding it, maybe like 90 cents, 80 cents a loss for 2020. So yeah, they're doing bad, But again, I think it could be much worse. I think their balance sheet again is pretty stable. I'm gonna check something real quick. All the data I use to track balance sheets and stuff, they don't have the information up yet, which is understandable. Like, this just got released. But again, their balance sheet it's strong. It's surprisingly strong. Their current ratio is a little low. I guess now real quick we should probably talk about if the dividend will be cut, what's gonna happen. I think this dividend is sustainable. They're very adamant about sustaining it. Now we have to talk about time frame. If 2021, the entire year, they're getting slapped, they're getting, very bad earnings, oil prices don't increase with demand, they can't get that margin, I don't think they will keep the dividend all through 2021. I think they got 2 or 3 quarters left in them. Probably 3 quarters. If after that time they don't see things happening, like in the economy improving, that'll benefit their business. I think they have to. Like, why would you? This is the other thing. You could technically keep on buying debt and sustaining the dividend and refinancing it and finding some loopholes and stuff. I don't recommend a company to do that, but you can do it. That's the weird thing. I'm not saying they should, and I would be suspicious if they did, because it just shows, this company doesn't have a lot of debt. They're managing they have like 2 or 3 times the amount of assets than liabilities. It's just, I think you got a couple quarters left in this company before they really are like, you know what, we gotta cut it. That's my opinion and my take. I already have a decent sized position, in my percentage wise of my portfolio in Exxon. At these prices, at my age limit, this is more of a speculative risk. The company is no doubt sustainable. It's an aristocrat. It's just, we don't know how long this cyclical thing is gonna last, and I don't know if I want to wait and bet my money on it with them probably gonna cut it. I think this is again more of a speculative investment, if that makes sense. It's not a trade, because it's cyclical, speculative dividend investment, because the company has a good balance sheet, I think good team, good business. It's just the margins and demand and oil, it's just everything lined up really is hurting them. I think they got a couple quarters left of the dividend, and if things don't improve, I might, get suspicious. But again, in my age, getting a starting yield at 10% on a possible cyclical play might be very smart. That's just my thoughts about it right now. We'll see how the market reacts today. And, because again, the dividend price has nothing to do with, like, the sustainability of the company, kind of. But it has to do with, like, the payout ratio and how they're financing the debt of the dividend. And right now, they're not financing it in a way. They're just financing it based off of how they're using their balance sheet, which isn't sustainable over a very long period of time. Short period of time, yes it is, but it's not over a long time. The only thing that dividend means is this company is trading at a certain price, and their dividend is just that, a certain price too. Just because it's a 10% dividend doesn't mean they will cut it. It does show uncertainty that the market has about the company, but it doesn't mean that they have to cut it just because it's a certain price. And that's the thing people gotta keep in mind. Could I be kind of wrong? Yeah, of course, but everything I've looked at, that's what it kind of points to. Anyway, long video. Hopefully you enjoyed. I'll see you guys in another one. Adios.